Numbers don't panic, people do. Let's look at the psychology driving today's market. A recovery can move quickly in price and still feel painfully slow when participants judge it against an earlier peak. That feeling is not necessarily irrational. A gain from a depressed level and a return to a previous reference point answer different questions, even though both describe the same sequence of prices. The opening puzzle is simple. Why can a strong rebound feel incomplete? The answer begins with the mental baseline participants use when deciding whether conditions have improved enough. A reference point turns movement into meaning. Without one, a rise is merely a rise. Against a remembered peak, the same rise can still be experienced as unfinished repair. This episode separates arithmetic recovery, psychological recovery, and structural recovery. They may overlap, but none automatically establishes that the others have occurred. This separation keeps the argument analytically clear. The core claim is bounded. Anchoring to a prior level can slow the feeling of recovery, while incentives, liquidity, fundamentals, and individual circumstances still influence actual participation. The comparison point determines which description feels dominant. After a sharp decline, the current price becomes only one visible fact. Participants may compare it with entry prices, previous peaks, recent lows, expected value, or the level needed to meet obligations. Those reference points can conflict. A new participant may see an attractive improvement, while an earlier participant sees only a partial reversal of a loss already carried. Different baselines can therefore support different interpretations. Notice the distinction. The market has one transaction price at a moment, but participants can hold many psychological baselines. Shared sentiment emerges from their interaction rather than from one shared anchor. A rebound, therefore, does not create one emotional response. Relief, regret, skepticism, urgency, and indifference can coexist because each response depends on a different comparison. That plurality matters throughout the entire recovery process. The recovery mirage appears when attention remains fixed on the lost height. Progress from the low becomes visually and emotionally smaller than the remaining distance to the old reference. The crowd creates the feedback. When many participants describe improvement as insufficient, cautious participation can reinforce the impression that recovery lacks conviction, even without establishing what prices will do next. Begin with arithmetic. A decline and a later gain use different starting bases, so equal-looking percentages need not cancel each other. That is a mathematical property, not a psychological finding. Imagine an asset falling from 100 units to 50, then rising by 20%. The new level is 60, which remains below the original reference despite a meaningful gain from the low. The example is constructed, not historical evidence. Its purpose is to show why a large percentage bounce can coexist with a substantial remaining gap relative to an earlier peak. Psychology enters when the earlier peak becomes the dominant baseline. Participants may interpret the remaining gap as the main story and discount the improvement already achieved. The baseline organizes how improvement is emotionally classified. Reference dependence means outcomes are evaluated relative to a comparison point rather than only by their absolute level. In markets, several comparison points can compete at once. Such framing can persist even as conditions change. An entry price may matter because it defines personal profit or loss. A prior peak may matter because it represents missed opportunity, lost status, or a familiar picture of normality. Now, a recent low can become another anchor. Participants who entered near it may experience the same rebound as success, creating disagreement between groups observing identical transactions. The same observation can support several reasonable narratives. That disagreement helps explain why recovery sentiment can look fragmented. The price is shared, the histories attached to it are not. That tension remains central to the psychological mechanism. Loss aversion can deepen the asymmetry, but the phrase must be used carefully. Conceptually, remaining below a valued reference can keep attention focused on what has not been regained. This does not mean participants necessarily feel losses more strongly in the same way. Time horizon, wealth, strategy, obligations, and prior expectations can alter which comparison matters. The reference influences attention before it influences action. Anchoring also affects interpretation of new information. Positive developments may be viewed mainly as steps toward restoration rather than as independent reasons to revise expectations. Context decides whether that reference remains useful. Here is the feedback loop. A high reference makes progress feel incomplete, Incomplete progress supports cautious narratives, and those narratives may influence participation and the language surrounding the rebound. Participation can then shape the visible recovery. Some participants may wait for stronger confirmation, while others may reduce exposure as prices approach levels associated with earlier disappointment. Personal history changes the meaning attached to movement. Price is evidence of transactions, not a direct reading of emotion. Waiting, selling, buying, or remaining inactive can each reflect multiple motives beyond the reference point. Shared discussion can make one baseline unusually prominent. Another layer is memory. Peaks are memorable because they organize stories about what was possible, what was lost, and what participants believe should eventually return. The effect depends on which comparison stays mentally available. Yet memorable does not mean economically justified. A prior high may reflect conditions that no longer exist, making attachment to it psychologically understandable but analytically weak. That distinction prevents arithmetic from becoming emotional proof. Social comparison can strengthen the anchor. Participants may hear others discuss the old level repeatedly, giving that reference greater prominence even when their own circumstances differ. Several motives can produce the same visible transaction. Repeated attention can make a reference feel objective. The level becomes a shared landmark, although its importance still depends on beliefs, positions, and the surrounding market structure. The mechanism remains conditional rather than broadly applicable. Recovery narratives also compete. One story frames the rebound as restoration. Another frames it as temporary relief. A third treats the decline as a lasting change in expectations. Look, each narrative directs attention toward different evidence. Restoration emphasizes distance regained, temporary relief emphasizes fragility, and structural change emphasizes why the old peak may be irrelevant. Each group may therefore describe recovery differently. These stories can influence behavior without reliably predicting direction. A narrative may coordinate participation, but it does not control new information, liquidity, or fundamental conditions. Interpretation changes when the chosen baseline changes. Reference points can shift over time. A level that once defined normality may lose influence as participants change, positions turn over, and new information reorganizes expectations. Salience can outlast the conditions that created it. That shift is one route to psychological recovery. The market need not return to the old peak for participants to adopt a new baseline and evaluate outcomes differently. However, the opposite can also occur. A prior peak may remain salient for years in memory, commentary, and personal accounting, even when its economic relevance has weakened. That possibility limits any simple crowd explanation. A structural explanation may dominate. Slow participation could reflect financing costs, uncertain cash flows, damaged balance sheets, reduced liquidity, or changed rules rather than psychological anchoring. Analytical discipline requires keeping those alternatives visible. A rebound can also feel incomplete for rational reasons. The current level may genuinely remain far from an estimate of value, required return, or a participant's specific obligation. Some sophisticated participants deliberately use reference levels as disciplined decision inputs. The presence of an anchor does not prove bias, because the reference may contain relevant information. Reference dependence cannot replace valuation or structure. Another limitation is measurement. Observing hesitation near an old level does not reveal whether participants are anchored, taking profits, managing risk, or responding to unrelated constraints. The older level may still carry symbolic importance. Psychological interpretation is strongest when it explains behavior that structural factors leave unresolved. It should supplement evidence about incentives and conditions rather than replace them. That symbolic role may exceed its present economic relevance. A validating conceptual case is a vessel partly refilled after losing fluid. The refill is real, yet an observer comparing it with the original level still sees an unfilled gap. The metaphor also shows why the feeling of recovery is not a forecast. A partly refilled vessel may continue filling, remain stable, or lose fluid again. Multiple anchors can pull interpretation in opposite directions. The opening question can now be resolved. A bounce feels slow when participants measure progress from the prior peak downward rather than from the recent low upward. Baselines matter. The same movement supports both descriptions. It is fast relative to the low and incomplete relative to the peak, so disagreement can arise without either side making an arithmetic error. Psychological time follows the reference point. When attention remains on restoration, each gain is treated as reducing damage rather than creating a fresh positive outcome. Longer-held positions may preserve it as the dominant benchmark. This can affect confidence and participation, but only conditionally. Participants still respond to expected value, liquidity constraints, and their beliefs about what the old level represented. The same rebound can therefore carry conflicting emotional weight. Emotion can amplify the move. Relief may encourage re-entry, while regret or distrust may delay it. Yet none of these responses establishes the next direction of price. Uncertainty about value can keep those baselines unstable. The recovery mirage is therefore a framing problem, not proof that recovery is false. It describes why improvement can be underfelt while remaining economically meaningful. New information may eventually reorder their importance. Recognizing multiple baselines also reduces careless claims about market sentiment. What appears to be one hesitant crowd may be several groups comparing the same price with different histories. The strongest conclusion is plural. Arithmetic, psychology, and structure each define recovery differently. Clear analysis states which definition is being used before interpreting behavior. That reordering can change sentiment without restoring the peak. Now, application begins by naming the reference point. Ask whether the discussion compares current conditions with the peak, the low, an entry level, or an estimate of value. Then separate the observed transaction from the inferred feeling. A rebound is observable. Disappointment, relief, and distrust require additional evidence rather than assumption. Participation may shift as the dominant comparison shifts. Study the herd without following it. Notice which baseline dominates public narratives and which groups might reasonably use a different comparison. None of this supplies a directional trading signal. Compare psychological and structural explanations. Hesitation may reflect anchoring, but it may also reflect weaker fundamentals, constrained liquidity, or uncertainty that has not been resolved. The framework explains perception rather than future price. Ask what would falsify the anchoring interpretation. If behavior changes with new fundamentals rather than proximity to the old level, the reference point explanation may add little. Structural evidence should remain part of the assessment. Behavioral analysis remains educational. It cannot reliably identify a recovery timeline, predict participation, or direct a trade, and it does not remove the possibility of further loss. Psychological language must not substitute for observable conditions. Observe the behavior, not the prediction. Use reference points to understand conflicting reactions while preserving uncertainty about price direction and the reasons any participant acts. Alternative causes deserve equal analytical attention. The practical implication is modest. Define the baseline before judging recovery. A movement can be substantial, incomplete, encouraging, and fragile at the same time under different comparisons. That boundary protects interpretation from overreach. A recovery may be real before it feels complete, and it may feel complete before structural conditions improve. Keep those layers separate. Don't follow the herd. Study it. See you next time.